Hello, this is Wilfred Hahn, the Chairman and Chief Investment Officer at Hahn Investment Stewards. I'd like to do a monthly update. We're now using this new video format. I hope you like it. We're going to review the month of January, extraordinary month. In fact, very extraordinary for Canadians. Most Canadians will have enjoyed some very, very good returns, particularly because the Canadian dollar was so weak. I want to just review some of the movements in markets last month. If all fixed income assets around the world did very, very well, interest rates continue to fall. Amazingly, long-term bonds have outperformed equities now for quite some time. Very important contributor to returns overall. As mentioned already, the US dollar has been strong, and by virtue, the inverse of that is the Canadian dollar has been weak. Remarkably so, in the month of January alone, the Canadian dollar fell almost 9%. For those of you who have international content in your portfolios, that of course will have contributed quite nicely as you translate back those gains into Canadian dollars. On the commodity side of things, not much going on there that's any different here in recent months. They continue to fall overall. The only contrary trend is gold. Gold has strengthened here in the last couple of months, up 14% in January alone. All of our portfolios do hold a small position in gold miners, and that would have definitely have contributed to performance overall. Let me jump next just to the overall performances of our portfolios. Remarkably, some of our balanced portfolios rose over 10% in 1 month, if you can believe that. Of course, that's not going to be sustainable month to month here. Those being some of the more aggressive balanced accounts. And as mentioned already, the Canadian dollar, of course, was such a huge contributor to those fantastic gains. Well, what could happen next to the Canadian dollar, as we have often presented in our publications and in this overview here, which we do monthly, we have held a negative perspective on the Canadian dollar here for quite some time, a number of years. It's panned out, and as you might have noticed, for a period of time, last month, the Canadian dollar even broke through the 80-cent level versus the US dollar. The Canadian dollar can continue to weaken, and we expect it probably will do so. I think it is reasonable to conclude, though, here looking longer term, that the Canadian dollar has already given us the biggest advantages that we'll be seeing here in terms of portfolio gains. After all, the Canadian dollar was as high as 110, if you recall, back in 2009, and here we are, as I mentioned last month briefly, below the 80-cent mark versus the US dollar. So as you'll see in the exhibit here, our performances across the board for all of our balanced portfolios did very, very well. And as mentioned, roughly in the sort of the 6 to 7% range to the plus 10% range for our more aggressive portfolios. They all are balanced, of course. And as mentioned, those performances have been very, very stellar. Looked at over a 12-month environment, the returns there are anywhere between 13 to 17, 18%. And these numbers, by the way, as we always have to disclose, do not include costs and fees. The reason that we do present these, as you'll see on that exhibit, is because the fees are different for different portfolios and so forth. Well, the big question here is, where will future returns come from? We all know that interest rates have continued to fall very, very substantially. They continue to fall. Last month, again, around the world, and so far here in February, rates continue to fall. A number of central banks around the world have cut rates again. Australia, Denmark recently again cut, actually yesterday. They're down to negative 0.75% in terms of the administered rate. So can you imagine, for the privilege of holding your money in a Danish bank, you will be paying 0.75%. It's a completely new world, a different world. What's happening, as everybody will realize, is that as interest rates fall, returns, of course, from interest income and dividend income, to the extent that they fall as well as a percentage of assets, means it's going to be a smaller and smaller contributor to overall gains. And what happens is everyone then becomes much, much more reliant on capital gains, whichever way that might occur, on securities, currencies, and so forth. So that's kind of the nature of the world that we're in here right now with rates so low. Can it continue? Can expected returns stay robust, and the present trends that we've seen continue after a blowout month like we just experienced here in January? Of course, we don't expect that that's going to happen every month. So, to the extent is we're going to see a bit of a reversal. But again, it's a valid question longer term. When we look at what's happening around the world and look at the major drivers that have contributed to the decline in interest rates, we have to say honestly that the trends that we've seen can continue. We're not saying they will continue, but they can. There's a big intergenerational wealth transfer ongoing in the world, particularly so here in North America as populations become older. On the one hand, interest income becomes much more sought after because a greater and greater proportion of society in their retirement is going to be depending on those earnings. Our firm long has predicted and talked about well over 10 years, probably 15 years, about the global income crisis, and it indeed is playing out, and it's one of the reasons why anything with an income continues to be bid up, and in fact will continue to be bid up in years ahead as, again, future retirers become all the more searching for income that they can then use in their retirement years. So that's ongoing. We have slowing growth still all around the world, not recessions, but commodity prices have been falling. Inflation, therefore, has been continuing to fall. So there, again, is sort of underlining our belief that the trends that we've been seeing here can continue. We do think it'll become much more volatile, but these underlying drivers are very different. They're unprecedented, and this is unprecedented because the underlying fundamentals are unprecedented. So we still hold to the view that returns overall should be modest over the long term. That's always a function of interest rates, or I should say it's got the highest correlation to interest rates. Since interest rates are lower at their lowest level, that also means that long-term investment returns are going to be lower as well. But nonetheless, continuing to see still performance possibilities longer term. So that's our review for this month. May we invite you to visit our website. We continue to put out publications. Most recently, the Global Wealth Perspectives was published. We invite you to read that. There's some commentary on our current portfolio strategies, as well as some of our overviews on the investment environment. And most recently, also another article published on the question of future expected returns. So we invite you to look at that, and we'll meet with you again next month. Thank you for joining us. Goodbye.